order to take the right decision at the right time, so accounting information is a base. So where in MBA, financial accounting for managers is a very important paper. So the accounting information is a base for the management to take the right decision. Business concern. Business is an economic activity which main objective is earning profit through buying and selling of the goods and services. So every business, whether business is a small business, medium business, large business, its objective is earning profit. So after doing the business at periodical intervals, the trader, businessman is very much interested to know the results of the business, whether he earn the profit or incur the loss, if so how much. In order to know the results of the business, he prepare some important accounts and statements at the end of the particular period, known as the final accounts or financial statements. With the help of our presentation of the final accounts and financial statements, we are able to know the performance of the business concern and how the business is performed, whether the business concern achieved the objectives or not, whether the concern earn the profit or incur the loss, if so how much, what is the financial position of the concern. All these aspects you know by preparing the final accounts and financial statements. Generally, the accounting cycle, that is steps involved in the accounting process, step by step activities involved in the accounting cycle, phase by phase. Generally, business transactions are recorded. So in first and foremost book known as the journal. So to record the transactions, there are two systems are there, single entry system and double entry system, where while recording the business transactions, out of there are generally two aspects are involved, namely debit and credit. Out of debit and credit, only one aspect is considered. Such system is known as the single entry system. Out of two, that is debit and credit aspects of the transaction, two aspects of the transaction, both debit and credit is recognized and recorded. Such a system known as the double entry system. Generally, the small business concern like sole trading concern, they are follow the single entry system, where the big business concern, especially giant stock companies, generally follow the double entry system. So after recording the transactions as per double entry system in the book of journal, so then they prepare the ledger. Because what is ledger, what is the need to prepare the ledger is another step. So where in journal the transactions are recorded only in the form of entries. It doesn't give the net effect of any aspect. That is, what is the total sales, what is the total purchase, what is the total income, what is the total expenditure, all these aspects you don't know by preparing the journal. In order to overcome these limitations, so in order to know the net effect of various aspects, they have prepared the various accounts. For this separate book is prepared, that is known as the ledger. So ledger is a book which contains the various accounts. After transferring the aspects from journal to ledger, so after completion of the postings, they can balance the ledger. Some few ledger accounts shows the debit balance, few ledger accounts shows the credit balance. So to record the debit credit balances of the ledger account, they prepare separate statement known as the trial balance. Trial balance is a statement of various debit credit balances of the ledger accounts. It is prepared on particular date to know the arithmetical accuracy of the books of accounts, whether the transactions are recorded as per double entry system accurately or not, is there any errors or not, that you can verify, check, confirm the arithmetical correctness, arithmetical accuracy of the books of accounts you may be known by preparing the trial balance. If any error are there, that you can locate by preparing the trial balance. Wherein trial balance is a statement of various debit credit balances of the ledger account. If both the debit and credit, the total of debit and credit are equal, then automatically then it will be, it implies that the transactions are recorded as per double entry system. After preparing the trial balance, they can move for the last step. It is the final step, preparation of the final accounts and financial statement. So when in accounting cycle, it is the last step or stage, hence it is termed as the final accounts. Where in accounting period, in last date, so last day it is prepared, these accounts are prepared. Where in accounting cycle, it is a final step or last step, you are preparing these accounts in order to know the business result. Hence these are known as the final accounts. In order to know the financial performance of the company, you are preparing these statements. Hence it is termed as the financial statements. So what is final accounts or financial statements? They are very clear. Then who prepared this final accounts? When it is prepared, how it is prepared? These are the two questions. Let us see. What is financial statements? Already known. These are the statements course are prepared by the business concern or entity at end of the particular period to know the results of the business. That is whether the concern earn the profit or incur the loss. If so, how much? What is the financial position of the concern on particular date? You may be known. So to know all these you prepare some important accounts and statements at end of the particular period. These accounts or statements are known as the final accounts or financial statements. So who prepare? Business concerns especially. So whether the concern is a small, big, large, all business concern generally prepare this financial statement. When it is prepared? At end of the particular period. Period may be yearly, half yearly or quarterly prepared. That is depends upon the need and requirement of the management. These final accounts or financial statements are prepared. Then last one is how it is prepared. In the preparation of the final accounts and financial statement, there are 3 steps are there. Or step 1 is preparation of the trading account. So second step is preparation of the profit and loss account. Third step, preparation of the balance sheet. So there are 3 steps or stages are involved in the preparation of the or gross loss. So by preparing the profit and loss account, you are able to know the net profit or net loss. By preparing the balance sheet, you know the financial position of the concern. Financial position, nothing but the information relating to assets and liabilities held by the business entity on particular date. Then coming to first step, that is trading account. What is trading account? How it is prepared? Name itself you are very clear. So it is an account prepared to know the trade result of the business. Trade result. The term trade refers to buying and selling of the goods and services. So by buying the goods and selling the goods, what is the gross margin or gross profit or gross loss of the business for a particular period, you are able to know by preparing the trading account. Then it is already known, it is account is divided in 2 parts. Left hand side meant for the debit, right hand side meant for the credit. So then each side we have a amount column. So this is a general format of the trading account. Left hand side meant for the debit, right hand side meant for the credit. Where debit side is particulars, amount in rupees, credit side particulars and amount rupees. Then coming to format, how it is prepared, what items that should be need to enter in debit side of the trading account, what items generally appear on the credit side of the trading account. Where in debit side of the trading account, first one is 2. Every item while recording debit side starts with TO2. 2 opening stock, that is the first item. Second one is purchases. So opening stock means what? There are 2 stocks generally need to study while preparing the final accounts. One is opening stock, another one is closing stock. What is opening stock? That is, it is a unsold stock lies in the business at the commencement of at the starting of the accounting period. So accounting period generally it is a there are 2 accounting period. One is calendar year, another one is financial year. Calendar year starts with January 1st of every month, ends with 31st December. Where the financial year starts with 1st April, ends with 31st March of next year. So it is a opening stock means it is unsold stock lies at the commencement of the accounting period, either January 1st or 1st April. That is the first item appeared on debit side of the trading account. Coming to second item, purchases. While recording purchase as a second item on debit side of the trading account, some important points should be noted. One is purchase means what kind of purchases, whether cash purchase, credit purchase. Here Total purchase you should be considered, that is called gross purchases. It includes both cash and credit. Out of total purchases, if any purchase returns are there, what is purchase returns? Out of total purchase, if in goods are damaged, defect, color variation, weight loss, it is returned to the suppliers again. Those returns are called purchase return. If any purchase returns, those returns you have to deduct from the gross purchases in order to get the net purchases. While preparing the trading account, care must be taken. You record only net purchases. Then coming to credit side. Credit side is already first item is sales. So after purchase, sales. Already known the trading account is prepared based on the nominal account principle. Under double entry system, there are three types of accounts. One is personal account, real account, nominal account. So personal account rules are there. Debit the receiver, credit the giver. Real account, debit what comes in and credit what goes out. Nominal account, debit all expenses, expenses, losses, credit all incomes and gain. While preparing trading account, you apply the rule of nominal account. What nominal account says that debit all expenses, losses. Whatever purchase is a general expenditure, hence we are recording on debit side of the trading account. Sales is a major revenue, income for the business concern. Hence it is showing on credit side of trading account. Again, while recording sales, care must be taken. Important points. Here, total gross sales you have to consider. Gross sales means what? Both cash sales and credit sales, if they are given separately, you have to add it to get the total sales. Out of total sales, if any sales returns are there, that is like purchase returns, out of total sales made to the suppliers, if any goods are damaged, defect, color variation, those goods are generally returned by the customers to the business entity. Such returns are known as the sales returns. If any sales returns are given in the problem while preparing the trading account, you have to deduct from gross sales. When you deduct the sales returns from gross sales, you will get the net sales. Net sales is the major item appear on the credit side of the trading account. Another item is closing stock. Already I said that there are two types of stocks. One is opening stock, another one is closing stock. Unsold stock lies at the. There are two types of stocks, very important while preparing final accounts. One is opening stock, another one is closing stock. Opening stock, already said that the stock, unsold stock lies at the commencement of the accounting period known as the opening stock. Generally, opening stock is the first item on debit side of the trading account. It starts with opening stock on debit side of the trading account. Closing stock means already I said it is unsold stock lies in the business at the end of the accounting period. So that is called closing stock. If closing stock is given, that it should be entered on credit side of the trading account. That is a major item. So opening stock, debit side first item opening stock, second time purchase less purchase returns, credit side sales and closing stock. Then what is the other items? So debit side opening stock purchase, other item is direct expenses, very very important, direct expenses. Then what is direct expenses? That is very important. So what is meant by expense? In relation to preparation of the final accounts, the expenses incurred in the business are classified into two categories. One is direct expenses, another one is indirect expenses. So what is direct expenditure? What are the examples of direct expenditure? What is indirect expenditure? What are the examples of the indirect expenditure? Then while preparing trading account, what kind of expenses we have to enter on debit side? That is very important. So the expenses, direct expenses, the expenses incurred in connection to purchase, the expenses incurred in relation to manufacturing, the expenses incurred in relation to production of goods and services generally termed as the direct expenses. For example, examples of the direct expenditure. So while purchasing the raw material and other inputs, so generally you are incurring the transport expenses. So carriage or carriage inwards, when goods are purchased from abroad, import duty, dock charges, then then wages. These are the remuneration paid to the employees who are working in the premises of the factory, wages. Then Other expenses incurred in the factory rent, lighting, insurance, etc. So then these are called direct expenses. While preparing the trading account, the first item is starts with opening stock and the purchase less purchase returns. Other items are direct expenses alone you have to record, not all kind of expenses, only direct expenses. Then indirect expenses means what? Already I said that in relation to preparation of the final accounts or financial statement, expenses of the business are broadly classified into two categories. One is direct expenses, another one is indirect expenses. What is indirect expenses? What are the examples of indirect expenses? The expenses incurred in relation to office expenses, administration, selling, distribution generally come under the head of the indirect expenses. For example, salaries, rent, rates, taxes, printing, stationery, postage, telegram, advertisement, salesman salaries, commission, interest, depreciation, then bad debts. All these are come under the all miscellaneous expenses, general expenses, sundry expenses come under the indirect expenses. Then while preparing a trading account, what kind of expenses we have to show? Both the direct or indirect, or only direct or only indirect. Very important point, note that only direct expenses alone you have to show on the trading account, not indirect expenses. So direct expenses is expenses incurred in connection to purchase, in connection to manufacturing, or incurred in the factory, such as the carriage inwards, freight, dock charges, import duty, then wages, factory rent, lighting, insurance, etc. All these expenses alone you have to record, not indirect expenses, only direct expenses alone you have to record. After recording the direct expenses, first item starts with opening stock, purchase less purchase returns, and all direct expenses depends upon the given direct expenditure items in the problem. You should be known what is the direct expenses alone you have to record on debit side of the trading account. We are coming to second year, sales out of total gross sales, you deduct the sales return to get the net sales, then another item is closing stock. So after recording this one, you have to balance the trading account. So generally credit is more than the debit side, then the difference generally known as the gross profit. That is very. In case while balancing the trading account, debit side is more than the credit side, you will get the gross loss. So the result of trading account either gross profit or gross loss only. So after completion of the preparation of the trading account, so you go for second step, where in the preparation of final accounts and financial statement, first step is trading account. By preparing trading account, the net result is to know the gross profit or gross loss. Second step is the preparation of the profit and loss account. It is the extension of trading account, because while preparing trading account, you are consider only one category of expenses, that is direct expenses, not all expenses. The remaining category, indirect expenses, is not considered. Therefore, the result of trading account, whatever profit, is not a final profit, it is not ultimate profit, it is a notional profit, hence it is termed as the gross profit. In order to know the final net profit, to consider the another category of expenses, that is indirect expenses, as extension of our trading account, we are going to prepare another income account, income statement known as the profit and loss account. Profit and loss account is generally prepared based on the nominal account principle. Already known as per double entry principle, there are three types of account. One is personal account, another one is real account, nominal account. So personal account rule, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account principle, debit all expenses, losses, credit all incomes and gain. What kind of rule you have to apply while preparing the profit and loss account mean? It is a nominal account, hence you have to apply the nominal account rule or principle while preparing the profit and loss account. That is, debit all expenses and losses, credit all incomes and gains. But the result, it starts with the result of the trading account. Trading account result either gross profit or gross loss. The trading account result is gross profit, that is the first item on credit side of the profit and loss account. Entered credit side by gross profit. If the result of the trading account is a gross loss, that is the first item entered on debit side of the profit and loss account as a gross loss. Then all indirect expenses what you are incurred. Already known that the indirect expenses relating to office, administration, selling and distribution. For example, salaries, rent, rates, taxes, printing, stationery, postage, telegram, advertisement, salesman, salaries, commission, discount, interest, bad debts, etc. Then all these expenses you have to record on debit side of the profit and loss account, depends upon the information given. Salaries, rent, rates, taxes, printing, stationery, postage, telegram, advertisement, salesman salaries, commissions, etc. Then in any incomes are there, miscellaneous income such as rent received, dividend received, commission received, etc. That you have to enter on credit side of the profit and loss account. After entering all indirect expenses on debit side of the profit and loss account, all your miscellaneous incomes on credit side of the profit and loss account, you have to balance. While balancing the profit and loss account, credit is more than the debit side, the result is known as net profit. In case debit side is more than the credit side, you will get the net loss. The result of the trading account is either net profit, net loss. So this is the second step in the preparation of the final account, that is preparation of the profit and loss account. It will give the net result, either net profit and net loss. Then the last one is, final step is preparation of the balance sheet. What is balance sheet? Why it is prepared? Who it is prepared? When it is prepared? How it is prepared? So what is balance sheet? First question, what is balance sheet? Who prepared it? When it is prepared? How it is prepared? Very, very important. Balance sheet is a statement of assets and liabilities of a business. It is prepared on a particular date to know the financial position of the concern. So financial position, when it is prepared, already know the financial statements are generally prepared at the end of the particular period. It may be yearly, half yearly, quarterly. That is depends upon need and requirement of the management. So then the final step is that is preparation of the balance sheet. Balance sheet is prepared to know the financial position of the concern. Financial position, nothing but the information relating to assets and liabilities. What is the assets? What kind of assets are there? What are the details? What is the, how many liabilities are there? Then how it is prepared? So balance sheet is divided into two sides. One is left hand side, right hand side. So right hand side meant for recording the assets. Left hand side meant for the recording the liabilities. Then while recording the assets on right hand side of the balance sheet, so how the assets are classified? So assets are generally classified. So assets are classified into tangible assets, another one is intangible assets. Again, tangible assets are fixed assets and current assets. Very, very important. Fixed assets is acquired, not for resale, retained in the business, used in long term. For example, land, building, plant, machinery, furniture, vehicles, premises, etc. Current assets is assets which will give the short-term benefit to the business concern, which can be convertible into cash within one accounting year. So intangible assets is not tangible, not visible, but they will generate the income, revenue, benefit to the business concern, such as goodwill, trademark, patent, copyrights, etc. So depends upon the details given in the problem, you have to enter all assets on right hand side of the balance sheet. So it may be, if it is a fixed assets, land, building, plant, machinery, furniture, fittings, vehicles, etc. Care must be taken while recording the assets on right side of the balance sheet. If any depreciation are given, that you have to deduct, and net value, net present value alone you have to record on asset side. Depreciation means what? The decrease in the value of the fixed asset known as the depreciation. The term depreciation derived from the Latin word depretium. D means decline, pretem means price. So totally depreciation according to Carter, permanent, gradual, continuous reduction in the value of the fixed asset known as the depreciation. If any depreciation are given in the problem, especially in the under the head of the adjustment, that you have to deduct, and the net value alone you have to show. After recording fixed assets, any current assets are there, for example, cash, bank, stock, debtors, receivables, marketable securities, inventories, etc. you have to record. Then intangible assets such as goodwill, trademarks, patents, copyrights, etc. record. Coming to left hand side of the balance sheet, liabilities. Liabilities you have to record on left hand side of the balance sheet. Liabilities are classified into three categories. One is fixed liability, long term liability, current liability. Current liability is a liability which is payable within one short period. Short period means within one accounting period. For examples of the current liabilities, creditors, bills payable, then outstanding expenses, bank overdraft, proposed dividend, provision for taxation, all these are the current liabilities you have to. Long-term liabilities, a liability is repayable after expire of the long period. The maturity period is long period. Long period may be 3, 5, 10 years, etc. For example, secured loans, mortgage loans, debentures, etc. Fixed liability is a one liability which it is a liability no need to repay until its liquidation. As soon as the concern is continued, until that no need to pay. Hence, generally capital is considered as a fixed liability. Capital is a what is meant by capital? How it's become a liability? Capital is investment made by the owner into the business. According to business entity concept, owner is differ with business concern. We are preparing all this financial statement for business point of view. Whatever investment made by the owner into the business, it's become a liability for the business. Hence, generally the investment made by the owner in the name of capital shown on liability side of the balance sheet. Care must be taken while recording liabilities on left hand side of the while recording capital on liability side of the balance sheet. So from capital, very important adjustments you have to make. The results of the profit and loss account, whether you earn the profit or loss, that you have to make adjustment. If it is a net profit, that should be added to the capital. If it is a net loss, that you have to deduct. Apart from adjustment of the result of the profit and loss account, net profit, net loss, another important is drawings. So if any drawings means whatever withdrawal, then there are two important aspects from the owner. One is capital, another one is drawings. Capital is investment made by the owner into the business, generally termed as the capital. If any cash, goods, assets withdrawn by the owner from the business is called drawings. If any drawings, interest on drawings, that should be deducted from the capital. Therefore, these are the three major adjustments you have to make to the capital on liability side of the balance sheet. If any drawings or interest on drawings you have to deduct, the result of the trading profit and loss account, that is especially net profit, net loss. In case net profit you have to add, in case net loss you have to deduct. So these are the important points noted while entering capital on liability side of the balance sheet. After recording all liabilities on left hand side, assets on right hand side, you have to balance, you have to total. Generally, the balance sheet should be equal or tally, because the reason behind why the balance sheet is tally means the trial balance is given as per double entry principle. If the errors are not there, all accounts are recorded correctly without error. If trial balance is tally, then the debit total is equal to credit. Automatically here the balance sheet is tally or equal. So this is the preparation of the final accounts or financial statement is a very important last and final step in accounting cycle. The objective of accounting is not only recording the transaction, not only maintaining the systematic books of accounts. Then in order to know the results of the business, he prepares some important accounts and statements at the end of the particular period, known as the final accounts or financial statements. So it involves three steps. One is preparation of the trading account, preparation of the profit and loss account. Why trading profit and loss account both are termed as the income statement, because you know the profit or loss of the business for particular period. Whether the trader earn the profit is incur the loss, if so how much, you are able to know by preparing the trading profit and loss account. Hence it is called as an income statement. So not only knowing the profit loss of the business, you want to know the financial position of the business concern. What is the assets, what is the liabilities, whether the assets are sufficient to pay all liabilities or not, whether the financial position of the concern is good or bad, financial health of the concern is good or bad, that you may be known by preparing the balance sheet. Balance sheet is statement of assets and liabilities. So with the help of the assets and liabilities, you are able to judge, conclude the financial position of the concern. Therefore, the preparation of financial statements is very important. This is very important information given by the accounting. This accounting information is useful for the not only for the owners and managers, various stakeholders who can interact with the business concern, take the decision based on the information contained in this financial statement. All stakeholders includes not only managers, owners and investors, creditors, employees, customers, competitors, public, researchers, even government. Various stakeholders who interact with the business concern, they take the decision based on the accounting information which is disclosed by the financial statements. Thank you very much. Please come.